there's a wide range of strategies and asset classes, but there's sort of two broad categories that we look at. So there's the index ETFs. So those are the ones that track the ASX 200 or the S&P 500 or, the Bloomberg bond index, or, there's a real estate index that you can track, or as I said, the small gold mining companies listed on the ASX that you can track. Those are ETFs that will buy all the constituents of the market. So if you buy an index ETF issued by, say, iShares, IOZ, it will have 200 shares in that unit trust. And you're buying a portion of those 200 shares when you buy an ETF that's listed on the ASX. Now, what index ETFs have is, they've got low fees. I think the IOZ is down to 5 basis points. There's an S&P 500 issue from Vanguard that charges about 3 basis points. So that's 0.03% of the asset base per annum. So it's very, very low cost. And what we say to people with index ETFs is that's typically what you should be building your core portfolio with. So if you've got, $100, you should have $70 to $80 in index ETFs, because they will track the market. They will give you an outcome that's probably as good as most active fund managers, in fact, probably better. I mean, what we've done and all the analysis that we do, and what the analysis that, say, S&P does, is that most fund managers, active fund managers, underperform their benchmark index. And partly that's because they've got trading costs, and it's partly because they charge higher fees than 3 basis points. And, if you think about it logically, it's very hard for fund managers to outperform. If there's one outperforming, there must be one underperforming. And it does become a sort of zero-sum game where it's the fees that make the difference. So we always say, go with a low-cost provider, go with an index tracker, because, for most of your money, because that will give you probably the best outcome. On the other side of the coin, obviously, there's now thematic ETFs and active ETFs. Thematic ETFs are the ones that say that will track, lithium stocks. So BetaShares, for example, has a whole bunch of ETFs that will track, electric car manufacturing companies. So they create an ETF that's got the Teslas, all the companies that make electric cars in the one ETF, 20 to 25 stocks. You can buy that if you think electric car stocks are going to outperform. As I said, you could buy equal weighted indices. So there's VanEck has a market, an equal weighted ETF. So they take the 200 shares in the ASX, and they buy 0.5% in each one. So effectively, you've got all 200 companies, but rather than being market cap weighted, which is what an index would do, they've only got 0.5% of their money into, say, Commonwealth Bank, rather than 11 or 12%, which is what you would have if you had a market capitalization index. The other side of the coin is there's now what they call active ETFs. They are essentially what active fund managers have sort of realized in the last 5 years, that it's much easier for investors to buy their funds through the ASX. So if you've got a managed fund, and Perpetual's done this, and Colonial First State has done it, and all the major fund managers, Magellan, they've all realized that it's easier to have a unit class in their fund that's listed, because there's a lot of people, as we said earlier, who like using their online brokers to buy and sell, because again, it's the click of a button. It's very easy to do. So you've now got on the market probably another 100 to 150 exchange traded funds, which we would call active exchange traded funds. InvestSMART, we have 4 that we have listed under the Intelligent Investor brand, and they're effectively an easy way to buy managed funds. But they're the same as the unlisted managed funds. You get the same experience, the same risk reward outcomes, but it's just a simpler process to buy and sell. So what we say is, in terms of using these, thematic and active ETFs, is get the majority of your portfolio into an index, 70 to 80%. And with the balance, the 20% that's left, then you can pick sectors that you think are important, or you can pick active managers that you think might outperform. There is a lot of analysis that you can see on whether active managers do outperform. Sometimes they outperform bond indices because, there's a little bit of, they sometimes have an information edge. Trouble is, it's not a persistent, over 5 or 10 years, it tends to dissipate that advantage that they have. Even small company funds, which you would expect small company managers to have a better chance because they're doing a lot more research. There's less publicly available research in small companies. But again, they do outperform at times, but over the long term, they do tend to drift back to below the index. And but if you have a theme and you've got a theme that you think is going to work, like buying gold, for example. So that's something you can do now with thematic ETFs.
Just back to equal weighted ETFs, why would you do that rather than invest in a market weighted ETF? What's the thinking behind doing that instead of of an index, a fully market weighted index one?
Well, Alan, there's been a lot of talk that Commonwealth Bank is probably the best example of where there's a lot of industry talk in the press where the price of Commonwealth Bank has been pushed up because index funds are buying it. So you may say, well, I think the ASX is a good place to invest, and I'm still not sure what companies to invest in. I haven't found a manager that I think is going to be active. If I buy an equal weighted index ETF, then effectively I've downplayed the size of Commonwealth Bank in my investment. So you sort of take a view of the top stocks, and there's some people have the same view about the US. The Magnificent Seven, and if you look at what the Magnificent Seven have done over the last 4 to 5 years, probably 70% of the performance has come from those stocks. So you may have the view that may not continue. So why would I buy an index market capitalization weighted index that's still got most of the money in those top 7? If I buy an equal weighted one, I'm sort of downplaying the size of those investments.
And I suppose what you're saying is that you think that the smaller companies in the index will outperform the bigger ones from now on.
Well, that's right. Yeah, that's the view you can take. Now, essentially, we've done some analysis on the market weighted versus the equal weighted ones. The performance is actually pretty similar. It's between, over the last 5 years, you would have got maybe a 1% outperformance with the market cap weighted one. So it's interesting that they haven't actually outperformed or underperformed particularly. So you say that they work, and you can see the logic behind it, but it's still probably true that index market capitalization index ETFs typically perform the best in all sorts of markets. But we haven't had sorry, Alan.
No, go on.
No.
You haven't had it. I was just saying there's a question from Jocelyn Lee, which is worth asking. She says, is an index ETF a better investment than a thematic one?
Well, to answer Jocelyn's question, it depends what you're trying to do. I mean, what we're looking to try and help people who are investing for the long term. And, we're typically dealing with people who have a self-managed super fund or who have, money outside of super, but have a longer term view. And we always say you're better going with an index ETF. And it's then important to pick whether you want to be in high growth assets like equities, or you want to be in defensive assets like bonds or property. You could buy a thematic index like gold, for example, but apart from the last 3 years, gold had done nothing for probably 10 years before that. So you could buy a gold ETF, so it holds physical gold, but would that be better than an index ETF? It will outperform over time, but if your investment strategy is to try and create wealth over the long term, you want to be in index ETFs.
Okay. That's good.
That's good. Yeah. So